What I'll do is I'll jump into one of my clients' refinances. This is actually the first refinance he did after his purchase. He opted to keep his monthly payment the same instead of capturing the savings. And what that did was it shortened his loan down to a 20-year. And so obviously everybody's going to be in a little bit different of a situation. The monthly payment, the interest rate is specific to his loan back in April. But the basic or the broad strokes on this is he kept his monthly payment the same, dropped his interest rate, and then the thing that changed was his loan term. He went from a 29.5-year loan, because he was 6 months into it, down to a 20-year loan on the very first refinance. There's three main things you're going to want to pay attention to whenever you're talking about the step down refinance or refinancing with anybody. The first one is you want to pay attention to what the payoff is and the new loan amount. You can see here that the payoff is 536,722. His new loan amount is 536. There wasn't a single penny added to his loan balance. It actually went down by $700. The other big thing that people want to pay attention to is the total loan cost. You can see this added up on line D of a closing disclosure or loan estimate. It says loan cost A plus B plus C. This is all those fees that go into originating a loan. We zero out what we can in the process, and whatever's not zeroed out at the end gets refunded directly to the client. So in this case, roughly $255 is what we owed to him after everything was said and done, in order for him to net a true zero on his total loan cost. The only other thing that he's going to be looking at is his escrows. If he decided that he wanted to have an escrow account, the escrows need to get funded somehow, because what ends up happening these days is the current escrow account in a loan cannot transfer to the new loan's escrow account. It has to get refunded to the client, but that creates a bridge that we have to gap, or a chasm we have to bridge. By increasing his escrow account at signing, we have to figure out a way to do it so that way his monthly budget doesn't experience any kind of bump. And the way we do that is by closing at the very end of the month or the very beginning of the following month. The idea is you bring in your mortgage payment to cover the escrow account that gets filled up. You won't have another payment until 30 days later, so you're not getting double popped on the mortgage. And then if there's anything left in your current escrow account, it gets refunded to you. The idea is you take that refund and you put it onto the loan principal so you can get that balance as low as possible, but you can do whatever you want with that money.